Welcome back to another video, guys. Today we're covering Alphabet. This is part of our FANG valuation series. This is the third company that we're covering. We covered Amazon and Facebook in previous videos. In this video, we're going to go over the 6 main drivers of Alphabet's business. We're going to go over our valuation model, explain how we got our valuation, and stay to the end of the video where we're going to discuss whether to purchase Alphabet stock today or should we wait and maybe there's other opportunities out there. So please like the video if you can. Takes 2 seconds and let's get into the video. The first segment of Google's biggest revenue driver is obviously their search engine. They have a 92% market share. It's the #1 most visited website on the internet. 63% of search results come from mobile, so that's a huge driver. And this is a huge majority of their revenue still comes through their search engine when you search something and there's ads that's being placed. So this is a huge and #1 revenue driver of Google. The second revenue driver is YouTube ads. YouTube has been one of the fastest growing segments for Google. This is like having a Netflix within a Google and the biggest AVOD or SVOD platform, which is advertising and subscription video on demand. When you watch YouTube videos, you usually get ads before, mid, and after the video plays. It logged in nearly $20 billion in revenue for 2019. They have roughly $2 billion in logged in monthly users, one of the biggest social media platforms on the internet. 74% of US adults use YouTube. So that's why you see a lot of players like Roku and Disney trying to come into this market and try to grab some market share from YouTube. And YouTube is a huge driver of Alphabet's overall business. And that's going to show in our numbers once we get to our valuation model. The third is Google's network. This is a pretty mature business for Google. It grows around 6 to 8% annually, and this is where Google places ads on other websites. So there's other websites on the internet. They are the ones placing that ad and having that distribution between the advertiser and the publisher. So this is a very mature part of Google's business, and it's been stabilized pretty much recently. The other segment is Google Other. This is where Android comes into place. A lot of these apps that you see here, Connected Home, Maps, Google Earth, all these other Google products that was not included in the other couple of segments, this is where that is included. Also, Google Cloud. This is a business that Google really wants to ramp up and catch up to AWS. Fastest growing segment out of the 6, and right now represents 7% of Google's total revenue. But we're going to talk about where we see this growth in our valuation model. And lastly is other bets. This is other bets pretty much that Alphabet is taking on. This is why they named the company Alphabet, because they are trying to diversify their revenue base beyond just the Google products that you and I know about. Right now, it hasn't materialized. It's less than 1% of the company's total revenue, but it includes Waymo, which is their self-autonomous driving division. They also have Google Fiber. They have a pretty much a venture capital arm. This is hemorrhaging money right now of Alphabet's total business, but the company wants to diversify and is betting that in the next 5 to 10 years, this is going to grow and take up a much bigger portion of the overall business. So let's go through my valuation model of this company. You see the breakdown of each of the top line revenue segments from 2017 to 2020. Those are the actual numbers that the company reported last year. They reported roughly $182 billion in total revenue. And you can see here that in this year, you're going to see a huge pickup in Google's main advertising business. I think the advertising business this year is going to ramp up significantly, as last year their advertisers pulled back on advertising spend. Now with all the travel and leisure, that's going to, and in the latest quarter, that's what they reported, is a huge ramp up in their advertising business. So we see Google search really picking up from last year, growing about 30% in this year, and then slowly maturing off in the next couple of years, and deaccelerating that overall Google search as the business continues to mature. YouTube ads, that's a huge part of Google's business. You can see from 2018, 2019, 2020 growing in the 30% range year over year. We see YouTube also following the trend with Google search, having a huge ramp up this year, but that is still going to be a huge portion of growth going forward, and we have this company continuing to grow this out to 35%, 30%, and 27% couple years down the line. Google Network, this is a slower portion of this business. We're going to say that it's going to grow around 8% for the next 3 years after this year. And we have Google Other. This is a huge segment portion of the business. I think this is the hardest one to tell out of the ones that we have covered so far. We're saying that this is going to grow to about $27 billion this year, and then growing 25% year over year for the next 4 years. And that growth has been up and down, but overall I think Google Other, with their hardware, the Play Store, that's going to also play a significant role in their business. This is comparable to what Apple is doing, with now they're focusing more on services. Google, with their Android platform, #1 mobile operating system, they want to leverage the Play Store, the hardware that they have, and so this may be a undershoot going into the future, but definitely this is just my model for the company. Google Cloud, fastest revenue driver right now. Last year they're $13 billion. This, I think they really want to ramp up and really compete with Amazon and Microsoft. So I say that this company is going to grow 45%. The segment's going to grow 45% and continue to deaccelerate into the future. And then other bets. This is the hardest one out of all of the 6 to really tell if it's going to materialize, because between 2017 to 2020, other bets really hasn't ramped up as much as maybe some analysts had expected, like what we did with Amazon, where the other segment really did ramp up with their advertising business that Amazon's doing now. So it's hard to tell. We're saying that in 2025, this does about $1.8 billion, maybe $2 billion. It's really hard to tell if this is going to materialize and where it's going to come from, whether it's from Waymo or it's going to be from Google Fiber. It's hard to tell on this end. So this is a key unknown in how we build out our model. So you can see all of this down here. The EPS that we're expecting for this year is around $76.50. By 2025, we're getting roughly around $150 in earnings. So again, in the spreadsheet model here, I built this out, and with a exit multiple, if you're looking at a PE exit multiple of 20 or a EV to EBITDA multiple of 15 by the end of 2025, you get a share price roughly around $3,000. And today's stock price is around $2,200. That gives you a CAGR of roughly 6%. So this is my model for the company. For a company as mature as Alphabet, I think this model is relatively stable and it's something that can be relied on, especially when you break down the top line revenue growth the way that I have. I also do a DCF on Google as well. This is pretty much taking the revenue that was in the exit multiple model for up to 2025 and then continue to have deaccelerated growth in revenue. And by 2032, we're saying that the company really just matures off and just grows at the pace of the US GDP. In this model that we have built, we get a estimated price per share today of $2,325. So with the current stock price, it looks like Google is fairly valued by the market, and the market has pretty much seen a model similar to the one that I have built out on both of these models. So it means that Google, the value of Google right now is fairly valued, and the market has priced in everything, all that growth from the 6 segments that I had listed. So in conclusion, our opinion is we have a neutral rating on Alphabet. With growth stocks right now going and starting to get hit, if Alphabet pulls back to around the $2,000 level, I think Alphabet is a good, compelling pick to make in the long term. Neutral rating just because based on the valuation models that we built, it looks like the market has priced in a lot of the growth that we see. Obviously, if you see more potential in the other bets segment, that may be the potential upside of the company. We don't have a position on Alphabet. I think the biggest driver of the company has to be continuing from YouTube and other bets. The other bet segment, if they're really able to ramp up a business similar to what Amazon has been able to do in the advertising business, then it's possible that Alphabet is able to be driven higher. But with tech stocks right now getting wrecked pretty badly, I think for right now I'm going to stick with a neutral rating on Alphabet. So I want to thank you guys for watching this video. Please like the video. If it only takes 2 seconds, really helps out with the YouTube algorithm. Subscribe. A lot of videos being posted. We are doing stock analysis on different companies, did earnings analysis on Playboy and Magnite. Check out the FANG valuation series as well on Amazon and Facebook if you haven't already. Going to make another video. Apple is going to be the next company in the FANG valuation series. Thank you guys for watching to the end of the video, and I'll see you guys next time. Peace.